we are going to be wealthy, right? We're manifesting it. We are going to be wealthy. We are going to have lots of money. Hi guys, my name is andiswa.mojapelo and welcome to my channel. If you are new here and it's your first time, thank you so much for stopping by. I really hope that you enjoy the content and you decide to stick around. We talk about all things related to money and adulting in general. And if you are a returning subscriber, thank you so much for coming back, and I really hope you enjoy this video as well. So guys, today we're talking about maximizing the value you get out of your tax-free account, okay? And I'm going to be taking you through why I think personally that you really are missing out if you do not already have one, and you are possibly missing out if you're not using it in the best way possible. And that's what we're chatting about today. But before we go there, right, let's start right at the beginning. What is this? Why is it here? What's the big deal? So in 2015, the government decided to bless all of us. And by all of us, I mean our parents, grandparents, children, everyone can have a tax-free account. They decided to bless us with this gift of a tax-free account, basically saying that anything that you contribute towards this account and whatever it earns in the account is going to be tax-free. There are obviously limitations. You have up to 36,000 Rand per tax year and a lifetime limit of 500,000 Rand. But let's stick on the positive, right? The gift in essence is that anything that is taxable in that account is going to be tax-free, like completely tax-free. And why is this important and why should we care? Because when you deposit cash into an account and you earn interest, you are actually liable for tax on that interest. When you buy shares and you decide to sell those shares at a profit, you are actually liable for capital gains on that profit. As you can see, the list is going on, right? You are liable for tax, a lot of tax when it comes to investments. But the government said when it comes to this specific account, you are not going to be liable for any type of tax in that account, okay? And this is why it's a massive benefit, because of all the tax that is related with investments and the fact that in this specific account, we don't have to pay that tax. We don't have to be liable for all these tax elements when it comes to that specific account. So why would the government do this? They did this because they want to encourage saving, right? They want to encourage a savings culture amongst South Africans. So then why did they cap it? Because if they didn't, then obviously the really wealthy people who have a lot of money to invest in the tax-free account would end up saving a lot of tax, which means that the benefit is actually quite enormous if you uncap it, right? And I think this is where our focus should be. If we are limited to 36,000 Rand per tax year and a 500,000 Rand lifetime limit, it means that the potential of benefits that we could actually get from having this account is that big that they had to be a limit. And of course, the other reason is that this benefit had to benefit the majority of South Africans, right? Not only the elite or the wealthy, but everybody had to have contributed a specific amount of money, or rather it should be open and available to everyone, and everybody should feel like they are getting a decent amount of benefit from this account, right? So that's why the tax-free account is here. Those are some of the examples in terms of what you actually stand to save by having one. But I'm also going to use a cupcake analogy, right? So forgive me for this, but I always find that when someone uses analogies in trying to explain something to me, the concept just lands easier and I'm able to remember it better. So I hope the same works for you guys. So we are going to imagine that the tax-free account is a cupcake, right? The first way in which you can make sure that you really benefit by having this type of account is to diversify the ingredients, right? Diversify the investment as much as possible. So a lot of people are unaware that you can actually have a lot of underlying investments in your tax-free account. So it doesn't have to be cash only. You can have ETFs, you can invest in unit trusts, in bonds, and there's a list, right, of the things that you can actually put in your tax-free account. And diversifying your tax-free account means that you will have dividends from your ETFs that are paying out dividends that you get to save from. You will have interest that you earn, and you will get to save the tax on that interest. And you will have a number of elements that you're actually saving from. Now, it's very important that you diversify with a growth mindset, right? So when you're thinking of what to diversify with, or rather what types of investments to put in your tax-free account, always have a growth mindset in mind. So what are some of the ETFs that I really think are going to do well? What are some of the interest bearing solutions that I can put in my tax-free account to make sure that I'm capitalizing on the amount of interest that I have? So this means that beyond just having cash in your tax-free savings, make sure that you are diversifying your tax-free savings, or rather the ingredients in our cupcake analogy, as much as possible, to make sure that your cupcake is growing and has the potential to grow as far as possible. So I'm talking baking powder there. I'm talking all of the good things that are actually going to enrich this cupcake of yours for the long term, to make sure that it has a good potential of growing. So that's the first tip in making sure that you are maximizing. Now, another reason why this tip is very important, guys, is that often I've heard people say, Andy, so when I look at my savings, my tax-free savings account with my bank, and I look at my other savings account, I don't see much of a difference. Where is this saving? So the reason why you don't see much of a difference, firstly, is that every single South African is allowed an exemption in the amount of interest that they're allowed to earn. So basically what this means is that if you earn interest up to, I think it's 23,500 Rand. I will put a correction if I'm wrong. If you are below the age of 65, that's how much you are actually able to earn in interest without being taxed, which means that if you're just earning interest, you wouldn't in any case fall below this limit and not being taxed more than that. The second thing, right? The second thing is, don't eat the cupcake. Okay, this is very, very important. And what this essentially is saying is that don't withdraw from your tax-free investment or your tax-free account when you have started contributing towards it, because there is a lifetime limit of 500,000 Rand and a tax year limit of 36,000 Rand. And I know that sometimes to most of us, this may seem like a lot. Right now, it may seem like, but what are the chances of me really reaching my limit of 500,000 Rand? It's more than enough. I can keep withdrawing. It's not like I'm going to run out. That's how you feel at the moment. But as time goes on, so for example, in order to reach that 500,000 Rand cap, you would have been contributing the maximum towards your tax-free savings for, let's say, about 14 years. That isn't a very long time, right? And because we're all using our money wisely and we are saving and we are making good, conscious financial decisions, we are going to be wealthy, right? We're manifesting it. We are going to be wealthy. We are going to have lots of money. So essentially, you don't want to find yourself in a position where you feel like, I've exhausted, when that happens, I've exhausted my tax limit and now I can't contribute anymore. And you start calculating all of the returns and all of the benefits that you would have had in the savings had you still had your allowance. So make sure that you don't eat the cupcake. That is the first reason why. The second reason why you must not eat the cupcake is because of compound growth. Remember that you have a certain amount of interest that you can actually earn on investments without being taxed, right? So most often, if you don't have that much money in an interest-bearing account, you're not going to pay tax anyway. So the value in the tax-free saving comes when you keep your cupcake as long as possible. What this does is makes sure that you accumulate so much in it that it becomes so big that the savings that you are saving through interest, the savings that you're saving through the dividends, are now much larger than it was when it was much smaller. But this can only happen if you are actually keeping your investment so long that it is compounding in terms of the growth, that you are adding dividends upon dividends, you are adding interest upon interest for the long term, and it is growing so much that you're like, sure, this is how much dividends tax I actually would have paid. This is a lot, or this is how much interest, this is how much I would have paid in on the tax element of the interest, and I'm actually saving a lot. But you only do that if you keep it long enough. So a very important part is, don't eat the cupcake. Keep it as long as possible. Don't break any pieces, because then you are not messing with the lifetime limit. The third thing, right, which is also very, very important, and a mistake that we often make, is that when you, for some reason, want to change what you have in your tax-free account, or you want to change where your tax-free account is held. For example, the reasons could be you feel like the fees are too high, or you feel like you can't invest in the things that you want to invest in order to diversify your tax-free account. make sure that you are transferring the account. You are not withdrawing from it and investing again, right? So there's a way in which you can actually transfer your tax-free account from one provider to another without upsetting the lifetime limit that you have. But if you withdraw that money out, or if you dissolve your investment and you withdraw it, and then you open another tax-free account elsewhere and you contribute again, that will be seen as a withdrawal, right? Which messes with the first thing that we discussed, which was don't eat the cupcake. So make sure that if for whatever reason at some point in your life you decide that you don't want your tax-free savings where it is and you want it elsewhere, make sure that you are transferring and you are not withdrawing. So guys, those are some of the benefits and those are some of the way that you can make sure that you are getting the most value out of your tax-free investment account. If you are currently using it as a transactional account, as a savings account, as an emergency account for short-term savings, etc., then you're unlikely to see the benefit of having a tax-free investment for the reasons that I mentioned. Please let me know in the comment section, do you have a tax-free investment account? Are you seeing the value yet? And if you don't have one, what are some of the reasons why you've decided not to get one? If you found this video insightful, please don't forget to give me a huge thumbs up and also consider subscribing to my channel if you haven't, so I can see you in the next one. Bye.